Welcome to the channel. Want to grow your wealth but not sure where to start? Investing is one of the best ways to build long-term financial security. In this video, I'll break down the basics of investing for beginners, covering stocks, ETFs, real estate, and more. Whether you're looking to start small or build a serious portfolio, this guide will help you take your first steps. So hit that like button and let's dive in. 10. Understanding the basics of investing. Investing is the process of putting your money into assets with the goal of generating returns over time. Unlike saving, which keeps money safe but offers limited growth, investing allows your money to grow through interest, dividends, or capital appreciation. Common investment vehicles include stocks, bonds, real estate, mutual funds, and exchange-traded funds, ETFs. Understanding how different investments work is crucial before you start. Investing carries risks, but with the right strategies and knowledge, you can minimize losses and maximize returns over time. One fundamental concept in investing is compound interest, which allows your money to grow exponentially over time. This means that the earlier you start investing, the greater your potential returns. Another important principle is opportunity cost. By keeping your money in a traditional savings account, you might miss out on higher returns from investments. Understanding these basic financial principles helps build a strong foundation for smart investing decisions. 9. Setting financial goals. Before you start investing, define your financial goals. Are you saving for retirement, a down payment on a house, or future education costs? Your investment strategy should align with your goals and time horizon. Short-term goals, 1 to 5 years, may require lower-risk investments like bonds or high-yield savings accounts, while long-term goals, 10-plus years, can accommodate higher-risk assets like stocks. Setting clear financial goals helps you stay focused and choose appropriate investment vehicles to achieve them. A key part of goal setting is determining your required rate of return. If your goal is to retire in 30 years, your investment portfolio should be structured to achieve an annual return that meets or exceeds inflation and provides sustainable growth. Additionally, breaking long-term goals into smaller, achievable milestones can help maintain motivation and track progress effectively. 8. Understanding risk and diversification. Every investment comes with some level of risk. Higher returns are often associated with higher risks. To mitigate risks, diversification is key. Diversification involves spreading your investments across different asset classes and industries to reduce the impact of any single investment's poor performance. A well-diversified portfolio typically includes a mix of stocks, bonds, real estate, and alternative assets. By balancing risk and reward, diversification helps protect your wealth while still allowing for growth. Another important concept is asset correlation. Some investments, like stocks and bonds, tend to move in opposite directions. During economic downturns, bonds may perform well while stocks decline. Understanding asset correlation can help create a resilient investment portfolio that withstands market fluctuations. Additionally, incorporating international investments can further enhance diversification and reduce overall portfolio risk. 7. Choosing investment accounts. Selecting the right investment account is crucial to maximizing returns and minimizing tax liabilities. Common investment accounts include brokerage accounts, retirement accounts like 401(k) and IRAs, and tax-advantaged education savings accounts. Each account type has its own tax benefits and contribution limits. Tax efficiency is another factor to consider. Taxable accounts allow for greater flexibility in withdrawals but require you to pay capital gains taxes on investment profits. On the other hand, tax-advantaged accounts provide benefits like tax deferral or tax-free growth, making them valuable for long-term investors. Planning your investments with tax considerations in mind can significantly impact your wealth accumulation over time. 6. Investing in stocks and bonds. Stocks represent ownership in a company and offer potential for high returns, while bonds are fixed income investments that provide stability. Stocks are ideal for long-term growth but can be volatile in the short term. Bonds, on the other hand, offer lower returns but provide a steady income stream. A balanced portfolio often includes both stocks and bonds to maintain growth while managing risk. Researching individual stocks or investing in stock indices can be a good starting point for beginners. Stock investing can be categorized into different strategies, such as growth investing and value investing. 5. Understanding mutual funds. Mutual funds are popular investment options that provide diversification without requiring active stock selection. Mutual funds are actively managed by professionals who select stocks and bonds to outperform the market, while track a specific index and have lower fees. Both options allow investors to gain exposure to a broad range of assets, making them a great choice for beginners. Understanding the differences between these funds helps you decide which aligns best with your investment strategy. Have gained popularity due to their liquidity and cost-effectiveness. 4. Developing an investment strategy. Creating a clear investment strategy is essential for long-term success. Strategies include dollar cost averaging, where you invest a fixed amount regularly to reduce the impact of market volatility, and value investing, which involves buying undervalued stocks. 3. Managing your portfolio. Regularly reviewing and rebalancing your portfolio ensures it stays aligned with your financial goals. Market conditions and life changes may require adjustments to your asset allocation. If one asset class performs well, rebalancing can help lock in gains and reduce risk. Using investment tracking tools and financial advisors can help you manage your portfolio effectively. Keeping a close eye on your investments ensures long-term success and helps you adapt to changing economic conditions. 2. Avoiding common investment mistakes. Beginners often make mistakes that can hinder their investment growth. Some common pitfalls include emotional investing, trying to time the market, and not diversifying enough. Many new investors panic sell during market downturns or chase high returns without understanding the risks. Avoiding these mistakes requires patience, a long-term perspective, and adherence to your investment strategy. Learning from experienced investors and financial experts can also help you navigate the investment landscape successfully. 1. Staying informed and adapting to market trends. The investment world is constantly evolving, and staying informed is key to making smart decisions. Follow financial news, read books on investing, and take courses to improve your knowledge. Pay attention to economic trends, interest rates, and market cycles to make informed investment choices. Being adaptable allows you to adjust your strategies as needed and seize new opportunities. With continuous learning and disciplined investing, you can grow your wealth over time and achieve financial security. And that's your beginner's guide to investing. The key is to start early, stay consistent, and think long-term. What investment are you most interested in? Let me know in the comments. If you found this helpful, don't forget to like, subscribe, and turn on notifications for more wealth-building tips. Thanks for watching, and I'll see you in the next one.